Assalamualaikum. Our group would like to discuss about Islamic fund management. So our group consists of 5 members, which is Muhammad ARIF BUDIMAN, Muhammad LUQMAN KHALIL, FATIN NAJIHAH, VAMELLA ZULHENDRI, and me NURHANIS IZZATI BINTI FAUZUDDIN. Okay, so I would like to present about the definition of fund management. Okay, so fund management is the process of overseeing and making investment decisions for financial assets to help individuals, institutions, or organizations to reach their financial goals. So fund managers develop investment plans, choose where to invest, and manage a portfolio of assets like stocks, bonds, and real estate to achieve the best returns while managing risk. So they analyze market trends, monitor the performance of investment, adjust strategies as needed, and report results to investors. So successful fund management involves understanding financial markets and making smart investment choice to meet financial objectives and maintain investor trust. Okay, so for Islamic fund management, Islamic fund management is a specialized branch of fund management that ensures all investment comply with Sharia, which is the Islamic legal and moral code. So this compliance involves strict prohibition against charging or paying interest, which is riba, as interest is considered exploitative. So investment must also avoid excessive uncertainty or speculation, which is gara, promoting transparency and fairness in transaction. Furthermore, Islamic fund management prohibits investing in business involved in activities deemed haram or forbidden, such as alcohol production, gambling, and pork-related products. So next is, instead of these forbidden practices, Islamic fund managers focus on ethical and socially beneficial investment. So common areas of focus include healthcare, education, and renewable energy, sectors that contribute positively to society and align with Islamic ethical standards. Other than that, the investment strategy emphasizes profit and loss sharing principle, where the return on investment are based on the actual performance of the business rather than guaranteed interest. So this means that both profit and losses are shared between the investor and the business, which fostering a more equitable financial relationship. Lastly, Islamic fund management incorporates charitable giving through zakat, so one of the 5 pillars of Islam. So a portion of the fund's earning is allocated to zakat, which is used to support charitable activities and aid those in need. So this practice not only fulfills a key Islamic obligation but also reinforces the ethical dimension of Islamic fund management by ensuring that wealth distribution benefits society at large. That's all for me. Thank you. And I will pass to the next.
Okay, next, let's talk about the differences between conventional and Islamic fund. Firstly, conventional fund aims for profit maximization without specific ethical guideline, while Islamic fund must follow Sharia principle, avoiding interest, uncertainty, and haram activities. Next, conventional fund have no special ethical screening, but Islamic fund undergo rigorous Sharia compliance checks. In terms of investment, conventional fund can use various instruments like bonds and derivatives, while the Islamic fund invests in Sharia compliant assets like sukuk and Islamic equity, avoiding interest and speculation. Okay, next, let's talk about the risk management. So for risk management, conventional fund use standard tools, while Islamic fund employs Sharia compliant methods aligning with Islamic ethics. Profit-wise, conventional fund focus on fixed return through interest, while Islamic fund emphasize profit and loss sharing, ensuring ethical financial practices. Last but not least, conventional fund are regulated by secular bodies, but Islamic fund have additional oversight from Sharia advisory boards to ensure they compliant. So to summarize, while conventional fund are profit-driven, Islamic funds align financial goals with ethical and religious standards. So I will pass to the next presenter.
Okay, let's talk about the modern and current development of the Islamic fund management industry. The first one is expansions of Islamic finance product. A wider variety of Islamic financial instruments such as sukuk, Islamic mutual funds, and takaful or Islamic insurance have been established in order to satisfy different needs of investor. The second one is geographic growth. The industry has expanded across its traditional markets in the Middle East and South Asia, establishing new markets in Africa, Europe, and North America. The third one is regulatory support. Governments and regulatory agencies in many different countries have implemented supportive policies and structures to help Islamic financial develop. For example, consider Malaysia's Islamic Financial Service Act 2013 and the United Kingdom's regulatory framework for Islamic finance. The next is technological advancements. Technological advancement, this use of fintech and digital platform has increased the accessibility and efficiency of Islamic money management service. Artificial intelligence or AI and internet investment platform are making it easier for investors to find Sharia compliance investment options. And the last one is sustainable and ethical investment. Islamic financial concepts are increasingly aligned with the globally trends to sustainable and social responsible investing. Islamic funds are increasingly incorporating environmental, social, and government or ESG concern into their investing strategies.
So next, we will discuss about the Islamic Investment Fund. So there is a difference and similarities between Islamic Real Estate Investment Trust REITs and Islamic Exchange Traded Fund ETF. So let's start with the definition. Islamic REITs are investment fund that owns, operate, and finance real estate properties in compliance with Sharia principles, focusing on real estate assets. So Islamic ETF, on the other hand, are investment fund traded on stocks exchanges that replicate the performance of Sharia compliance index, investing in a diversified portfolio of Sharia compliance stocks. So regarding Sharia compliance, both type of fund adhere to strict guidelines. Islamic REITs follow Sharia guidelines on property types, lease agreements, and financial transactions, while Islamic ETF exclude non-compliant companies and follow Sharia financial ratios to ensure all the investment are permissible and accepted. And the investment focus of this fund varies. Islamic REITs invest in real estate properties like commercial buildings, shopping malls, and residential complexes, providing exposure to the real estate market. In contrast, Islamic ETF offer a diversified portfolio of Sharia compliant stocks, offering broader market diversifications. In terms of income generation, Islamic REITs generate income through rental income and property value appreciation. Investors benefit from regular rental income and potential increases in property values. Islamic ETF generate income through dividend from underlying stocks and share price appreciation. Investors receive dividend distributed by the companies in the fund portfolio. And by continuing our discussion, firstly, considering the risk profile, Islamic REITs are generally perceived to have a lower risk due to their investment in tangible assets like real estate. These assets provide stability but are subject to market conditions and property values. In contrast, Islamic ETF carry a higher risk because they are exposed to the stock market. Thus, these also offer the advantage of diversification across various sectors. So next, let's discuss about the liquidity. Islamic REITs are typically less liquid than ETF, but listed REITs do offer better liquidity compared to unlisted one. So this means that while you might not be able to convert your investment to cash quickly, it is relatively easier with listed REITs. On the other hand, Islamic ETF are highly liquid as they are traded on stocks exchanges. So investor can buy and sell this fund during trading hour, so making them more accessible and flexible. In terms of management, Islamic REITs are usually managed by real estate professionals who handle operation, maintenance, and tenants relation. So these managers ensure that the properties adhere to Sharia guidelines while maintaining their values and income potential. Islamic ETF, however, are managed by fund manager who track the index performance and ensure all the investment comply with Sharia principle. So finally, considering the cost structure, both investment types have associated fees. Islamic REITs include management fee, property maintenance, and transaction costs. So these costs are linked to the physical management and upkeep of the real estate assets, while the Islamic ETF include management fee, trading fee, and potential tracking errors. So the costs of ETF are generally related to maintaining the fund portfolio and ensuring it closely follow the benchmark index.
Hello, hi. So my name is Budiman. So I'll be covering on the example of the REITs and also ETF. So in Malaysia, if investors are seeking Sharia compliant investment opportunities, they might consider options like Islamic REITs and also ETF. And two prominent choices in this space are Al-Aqar Healthcare REIT and also Wahid Investment. So the first one is Al-Aqah Healthcare REIT. So Al-Aqah Healthcare REIT listed on Bursa Malaysia, focuses on healthcare related properties including hospitals and also healthcare centres. The primary source of income for this REIT is rental yield from long-term leases with healthcare tenants, which provides investor with stable and predictable returns. Additionally, the value of the properties can appreciate over time and offering potential capital gain. And one of the key advantage of investing in Al-Aqah is the stability provided by its focus on healthcare properties. The demand for healthcare service tend to be relatively inelastic, which ensure the consistent rental income. And moreover, real estate assets serve as a tangible backing for the investment, offering a degree of security against inflation. But there are some limitations to Al-Aqah, basically mainly on the liquidity, because REITs is less liquid than ETF. Okay, investor may face some challenges in selling their shares quickly if needed. And additionally, the REITs is subject to sector-specific risks such as changes in the healthcare market and require active property management. Right, so next is Wahid Investment. So it is a digital platform that offers Sharia-compliant portfolios, including diversified global investment in equities, sukuk and also Islamic ETF. This platform aims to simplify halal investing by providing access to a broad range of securities that adhere to Islamic principles, ensuring that investments exclude non-permissible activities. One of the main benefits of Wahid Investment is its high liquidity, right? As an ETF-based portfolio, it allows investors to buy and sell shares on the stock exchange easily, providing flexibility, right? So the diversification across multiple sectors and geographies help mitigate risk and offers a balanced risk return profile. Additionally, the lower management costs associated with passive index make it a cost-effective option. But despite of this advantage, there are also some drawbacks for Wahid. The performance of ETF is subject to market volatility, which can affect returns. While ETF offer diversification, the potential for lower dividend yield compared to REITs exists. Furthermore, passive management might miss out on opportunities that active management could capitalize on. So like my previous group member have presented, when we compare Al-Aqah Healthcare REITs and also Wahid Investment, there are several key differences. And Al-Aqah focuses on real estate properties in the healthcare sector, generating income primarily through rental yield and also property appreciation. But in contrast, Wahid Investment offers a diversified portfolio of securities, providing income through dividends and also capital gain. And the next differentiating factor is actually liquidity. Like I said earlier, Al-Aqah REITs has moderate liquidity, whereas Wahid Investment ETF offer high liquidity, allowing for easier trading. The level of diversification also varies, with Al-Aqah being sector specific and Wahid Investment offer diversification across multiple sectors. Okay, so which one is suitable for investors? So the choice between Al-Aqah and also Wahid depends on the investor goals and also risk tolerance and also income needs. Al-Aqah is ideal for investors seeking stable income and exposure to healthcare and real estate. It provides tangible assets backing and can serve as an inflation hedge. However, it requires active management and comes with sector-specific risks. On the other hand, Wahid Investment is suitable for those looking for diversified and liquid investment options. It offers flexibility, lower management costs, and a balanced risk-return profile. Investors who prefer passive management and seek to minimize investment costs may find Wahid Investment appealing. So that is all from me. Thank you very much.